In late October of last year, in the first few of our first YouTube videos with Oak Harvest Investment Team series, I covered 4 of the real-time data series that we follow that were early warning signs of rallies, and then we followed it up with a video on 2 data series that are early warning signs of market tops and corrections. Here's the link to that content if you're interested. I'm Chris Perras, Chief Investment Officer at Oak Harvest Financial Group. The markets are in correction territory. We did forecast this back in the fourth quarter of 2021, saying we expected a -10% to -12% correction in the first quarter of 2022. Recall, viewers, definitionally, a correction is defined as -10% or more on the S&P 500. Well, if you were perfect at selling the cash closing high and buying everything back at the cash closing low on February 23rd, you avoided -11.85%. That would be particularly bad if you were leveraged, something we do not do at Oak Harvest. However, now many on TV are calling out many of the early warning indicators as bearish. Things like the flattening yield curve and higher bond volatility, the MOVE index, which supports collateral and leverage, which we spoke of back in the fourth quarter of 2021, are now becoming commonplace on TV. Given we're in our 3rd and possibly 4th month of a downturn, if you count late November as the top given when divergences began, I wanted to update our viewers on where a few of these indicators now stand. Why? Because a few are beginning to try to turn positive. Call this episode Early Optimism Signs. Now, despite being in a very messy time period that our team has been foreshadowing for months, in which we expect to continue for a few more months, I want to bring a little optimism to what might be equity investors' otherwise gloomy outlook. 3 data series that have historically led bottoms, lows, and pivots up during corrections we'll be covering are 1. Investor sentiment, 2. Forward volatility pricing, and 3. Market breadth. Viewers, make no mistake, this is not a dip, neither in price, percent decline, or length of time. So far, this has been a good old-fashioned gut check of a correction in the S&P 500. And unlike the fast and swift -5%, -3% dips we experienced from the second half of 2020 through the end of 2021, corrections take longer to rectify themselves, go deeper than run-of-the-mill dips, and 3 are best confronted more slowly due to extended periods of high realized volatility. Corrective markets like the one we currently appear to be in take months and quarters to play out, not days and weeks. They're best approached with a slower dollar cost averaging pace rather than a pray and pounce type trading behavior during quick dip movements. Viewers, against the backdrop of a horrible, unprovoked attack on Ukraine by Russia, it appears that some very early leading signs are in the process of troughing and turning towards more positive readings. The first early bullish sign is a contrary signal we've discussed in the past: individual investor market sentiment. From a contrary point of view, negative investor sentiment during corrective periods within bull markets is bullish. The AAII, that's the Association of Individual Investors, dropped below 20% for the first time in 6 years. Here's a table of forward stock returns provided by Merrill Lynch over the last 35 years. There were 13 such occasions, and the 12 and 18-month returns were very high. Even including the great financial crisis of a negative -35% return, the average 12-month forward return was over 15%. Other investor investment sentiment measures have similarly shown returns of 17.5% to 20% once sentiment flips positive from low levels such as these. Here's another sentiment chart provided by Ned Davis Research, like the Larry Williams indicator I discussed last week. It's a global stock versus bonds valuation ratio, and it has quickly fallen back to levels that signaled the last 2 great buy and mold opportunities over the last 24 months. Those being in April of 2020 during the COVID shutdowns and October 2020 in front of the 2020 presidential election. The second data set I wanted to flag is the recent uptick in improving market breadth. Yes, you heard that right. Market breadth is getting better, not worse. On Wednesday, March 2nd, the S&P 500 had a 11-to-1 upside day. This means that 11 stocks in the S&P 500 were positive on the day for every one that was red. According to research by Strategis, 15% of the S&P 500 had a positive 2 standard deviation move to the upside last Wednesday, and while that was below Friday, February 25th's 26% showing, it is still very high and indicates that behind the scenes, buyers are showing up en masse on weakness. Yes, the excuse you hear on TV that it's just short covering is probably true. However, sustained up moves have to start someplace, and given positioning and the amount of put buying done on the way down in January and February, short covering is the way the first move up is most likely to begin. The key to this indicator is looking for a second and higher breadth thrust day in the upcoming weeks. These types of days have historically confirmed that sellers are exhausted and the longer-term equity buyers have returned en masse. Historically, a lot of these days will come on a bad Friday and a positive Monday. Why? You get a lot of Friday margin call selling taking place, followed by more early Monday morning selling after the weekend. However, then a wave of forced selling exhausts itself early, and then the long-term buyers swoop in with liquidity and buy orders, reversing the markets higher later on Monday or Tuesday. If you want a classic example of this pattern, the best recent example was the COVID Friday, March 20th, and Monday, March 23rd lows, and Tuesday, 24th reversal up. A similar but more subtle pattern emerged on Friday, October 30th, and Monday, November 2nd, in front of the 2020 presidential election. The third and final indicator that provides a little early hope for more of a rally off the January lows in the coming second quarter, forward volatility market pricing. These forward pricing markets were one of the early warning indicators the team sleuthed back in the fourth quarter 2021 to forecast the current correction and timing. While this indicator is much more opaque now than it was back then, probably because of the ongoing Russian aggressions, they are saying that a lot of negative sentiment and downward price moves in percent terms were already priced into the S&P 500. These forward markets continue to trade at a level of around 28 or 29, and almost uniformly, when they get higher than this for a few days, insurance salesmen come in and sell forward insurance. This dynamic should be considered bullish for future time periods. In layman terms, it means that these insurance salesmen are still happy selling their insurance products out beyond 3 months at these levels. Even with COVID, even with the Federal Reserve uncertainty, and even with Russia invading Ukraine. As they have for 4 months, their look into the future beyond the first quarter of 2022 says they believe this too shall pass in the overall markets in the coming months. If you want some data, a recent piece of research done by JPMorgan gives us some historical reference around this topic of volatility. According to JPMorgan, a buy signal in the S&P 500 has been triggered when spot VIX index rose by more than 50% above its 1-month average. This happened on January 25th, according to their firm. Over the last 30 years, outside of recessions, this indicator has given a perfect buy signal 21 times since 1990, with the average gain being over 9% over the next 2 quarters. As we know, past performance is no guarantee and no indicator is perfect. So there you go. 3 indicators that are starting to lean positive for equities for the upcoming months. Are these perfect? No. Are they as precise and easy to read as they were in 2020 post-COVID or pre-2020 presidential election? No. There's a lot of messy, conflicting things going on, many of which we'd expected, and a big current one in the Russian invasion of Ukraine, which we did not. However, these 3 data series, sentiment, breadth, and future volatility, are starting to say, well, the next few quarters of 2022 won't likely be all rainbows and butterflies and ice cream. The clouds should start to clear in the not so distant future. At Oak Harvest, we think of our clients are best served by us helping them with their future needs and risks instead of dwelling on the past. Our crystal ball is far from perfect, but we like to keep you up on what it's saying about the uncertain future, not about what we already know about the certain past. Oak Harvest is a comprehensive financial planning advisor located in Houston, Texas. Give us a call to speak to an advisor and let us help you craft a financial plan that meets your retirement goals. Call us here at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Perras, and from the whole team here at Oak Harvest, have a great weekend.